Let's look at this chart together. At first glance, everything looks bullish. Price is making higher highs and higher lows. Most traders would open the chart, see this, and immediately think, the market is going up. I should be looking for a buy. But before I make any decision, there's one thing I always check first. I look at the volume, not because volume predicts the future, but because it helps explain what's happening behind the price. You see, price only tells us where the market moved. Volume tells us how much buying or selling happened during that move. And that's a very important difference. A strong price move backed by strong volume usually means buyers or sellers are actively driving the market. But if price moves a long way while volume remains weak, that move deserves a closer look. It tells us the market may not have as much conviction as the candles suggest. That's why professional traders don't judge a trend by price alone. They want to know whether the move is supported by real buying or selling pressure. Now let's come back to our chart. Right here, price is moving higher. So the next question is this move supported by strong buying? Let's look at the volume. Notice how each push higher is accompanied by increasing volume. That's exactly what we want to see. More buyers are joining the market. Demand is increasing. That means the trend has strength behind it. And when price and volume move in the same direction, the market is behaving normally. Now let's compare that with another section of the chart. Price is still making new highs. Everything still looks bullish. If you were only watching the candles, you probably wouldn't notice anything unusual. But look down at the volume. Each new move higher is happening with less and less volume. That tells us fewer market participants are supporting the move. The market is still moving higher. But the buying pressure behind that move is beginning to weaken. This doesn't mean the trend has to reverse immediately. Price can continue moving higher for some time, but without increasing participation, the trend becomes less convincing. Professional traders pay close attention to moments like this, because healthy trends are usually supported by healthy volume. When price continues making new highs while volume continues declining, it often tells us momentum is fading. At this stage, experienced traders become more cautious. They're no longer asking, is price still going up? Instead, they're asking, is there still enough buying pressure to keep pushing this market higher? Sometimes the answer is yes, but sometimes the market is moving higher simply because sellers are stepping aside, not because buyers are becoming more aggressive. That's an important distinction. A market driven by strong volume is very different from a market that drifts higher on weak volume. And understanding that difference can completely change how you read a chart. Now let's flip the chart. Imagine price has been falling for several hours. Red candle after red candle. Most traders are becoming nervous. Some are closing their trades. Others are panic selling because they think the market will keep dropping. Then suddenly, this candle appears. Before you even look at the candle, look at the volume. It's much larger than anything we've seen recently. Now look back at the candle. Price sold off sharply during the session. But before the candle closed, buyers stepped in. Price recovered most of the losses. That immediately tells me something important. Despite all that selling, the market couldn't stay down. Someone absorbed those sell orders. We just saw a candle with unusually high volume. Price dropped sharply during the session, but before the candle closed, buyers pushed it back up. So what does that tell us? It tells us that even though many traders were selling, someone was willing to buy everything they sold. Now, that buyer is usually not a retail trader. Large institutions have enough money to absorb that much selling pressure. This type of activity is often called stopping volume. Notice something important. Stopping volume is not an automatic buy signal. Instead, think of it as the market giving you a clue. It's telling you that sellers may be losing control. Now we wait for more confirmation before entering a trade. Let's move to another example. Price has been falling until it reaches this support level. Everyone can see this support. Because of that, many traders place their stop losses just below it. Now watch what happens. Price breaks below the support. Immediately panic begins. And many traders think the downtrend is continuing, so they sell. But then something unexpected happens. The next candle moves straight back above support. Now check the volume. It's much higher than normal. This is called a false breakdown, or what many traders call a spring. Why does this happen? Large traders know where retail traders place their stop losses. They push price below support, triggering those stop losses. As those orders are filled, institutions quietly buy into that selling. Once enough buying has taken place, price quickly moves back above support. The traders who sold the breakdown are now trapped. Meanwhile, smart money has built positions at better prices. That's why false breakdowns often become strong buying opportunities. Now let's switch to breakouts. Imagine price has been moving sideways for several days. Eventually, buyers push above resistance. At first glance, everything looks perfect, but don't enter the trade yet. Look at the volume. If volume expands well above average during the breakout, that's a good sign. It tells us many buyers support the move. The breakout has a higher chance of continuing. Now compare that with another breakout. Price moves above resistance again. But this time, volume stays low. Very few traders are participating. Without enough buying pressure, the breakout can easily fail. This is why professional traders don't chase every breakout they see. They wait for volume to confirm the move. Now let's learn one more principle that professionals use every day. It's called effort versus result. Volume represents the effort. Price movement represents the result. Normally, big effort should produce a big result. For example, if volume suddenly doubles and price explodes higher, everything makes sense. Buyers are clearly in control. But sometimes volume becomes extremely high and price barely moves. That should immediately grab your attention. A lot of buying is happening, yet price refuses to continue higher. Why? Because someone is selling just as aggressively. Large institutions are absorbing all that buying pressure. The trend may still look strong on the chart, but underneath the surface, the balance is changing. Whenever you see a mismatch between volume and price, slow down. Ask yourself one simple question. Does the effort match the result? If the answer is yes, the trend may continue. If the answer is no, the market could be preparing for a major reversal. Now let's look at the opposite side of the market. Instead of finding buying opportunities, let's learn how to identify high probability sell zones. Imagine the market has been moving higher for several days. Every pullback is small, every rally reaches a new high, news is positive, social media is full of traders saying the market is going much higher. Most retail traders are excited, they don't want to miss out. Then this candle appears. Price suddenly pushes to a new high. At first it looks like another strong breakout, but don't stop there. Look at the volume. It's much higher than normal. Now look at how the candle closes. Instead of closing near its high, it closes much lower, leaving a long upper wick. What does that tell us? It tells us buyers pushed the market higher, but sellers stepped in with enough strength to force price back down. Those sellers are often large institutions taking profits while retail traders continue buying. This pattern is known as a buying climax. It doesn't guarantee that the market will reverse immediately, but it tells us the uptrend may be running out of strength. Now let's look at another common setup. Price finally breaks above a well-known resistance level. Many traders see the breakout and immediately enter buy trades. Everything looks bullish. But watch what happens next. Before the candle closes, price falls back below resistance. Now check the volume, it's extremely high. This tells us the breakout failed. Large traders sold into the excitement while retail traders rushed to buy. This pattern is called an upthrust. It often traps breakout traders and can become the starting point of a move lower. Now let's talk about one final concept, volume divergence. Suppose price keeps on making higher highs. At first that sounds bullish. But each new high comes with lower volume than the previous one. That tells us fewer buyers are supporting the move. The trend is still moving higher, but the strength behind it is fading. The probability of a reversal is increasing. The same idea works in reverse. If price keeps making lower lows while volume keeps decreasing, it tells the sellers are becoming exhausted. Selling pressure is fading. The market may soon begin forming a bottom. Finally, before entering any trade, I always ask myself 3 simple questions. First, did unusual volume appear at this level? Second, did price react the way I expected after that volume appeared? And third, does the overall market structure support the trade? If all 3 answers are yes, then I know this setup deserves my attention. If the answer is no, I simply wait. Remember, successful trading isn't about taking more trades. It's about taking better ones. Price tells you where the market moved. Volume tells you how much conviction was behind that move. When price and volume agree, the market is usually giving you a much clearer message. And that's what separates professional traders from beginners. Professional traders don't guess, they wait for evidence. The next time you open a chart, don't just watch the candles, watch the volume, because that's often where the real story begins. Thanks for watching, and I'll see you in the next video.